For our leveraged buyout group project, we'll be discussing the Kinder Morgan LBO. Our group consists of Brandon Bittner, Stephen Crandall, Garrett McGee, and Connor McNally. Kinder Morgan is one of the largest energy infrastructure companies in North America and operates through natural gas pipelines, carbon dioxide, terminals, and product pipelines. The company has been very successful in its efforts and was one of the largest transporters of carbon dioxide and petroleum products in North America, as well as one of the largest independent carriers of petroleum products in North America at the time of the leveraged buyout. Kinder Morgan's terminals store and handle petroleum products, chemicals, and other products. Some of the company's critical assets include large liquids terminals and product tankers. The story of the Kinder Morgan leveraged buyout begins in February 2006 when Kinder Morgan president C. Park Schaefer enlisted Goldman Sachs to propose strategies in order to augment the gas and oil pipeline company's shareholder value. The alternative of a leveraged buyout was not suggested until March. In April, President Schaefer was joined by Rich Kinder, founder of Kinder Morgan and 18% owner of the company at the time, who was to lead a potential buyout group. The private equity arm of one of the world's foremost investment banks, Goldman Sachs Capital Partners, had negotiated a not-so-shabby arrangement with the Kinder Morgan Management Buyout Group to serve as the leveraged buyout's principal investor. Also included in the group were the private equity firms the Carlyle Group, Riverstone, and American International Group. In the subsequent months, the terms of the buyout were negotiated with Goldman Sachs Group on one side of the negotiation table, advocating the interests of Kinder Morgan shareholders, opposite Goldman Sachs Capital Partners, representing the investment bank's proprietary interests. News of these ongoing developments did not reach Kinder Morgan's board until May 13th. This deal is attractive to management for a number of reasons. For example, taking the company private will give management more flexibility in how they choose to finance future growth. Also, strategic alternatives allow shareholders to enhance their value. In addition, gas and oil pipelines can be augmented through the LBO opportunity. In addition, the company owns one of the nation's main transportation networks for petroleum products, carrying gasoline from refineries on the Gulf Coast to markets on the Atlantic coast. Another attractive aspect of the deal is the domestic reach of the company, with 43,000 miles of oil and natural gas pipelines and 150 energy terminals that represent a strategic and high-value investment that caters to the nation's growing energy demand while exposed to little of the price volatility in the underlying energy market.
The original leveraged buyout in May 2006 offered shareholders $100 per share, valuing the transaction at $13.5 billion. When the market closed the day before the transaction, shares of Kinder Morgan locked in at $84.41, leaving the premium per share at 18.5%. Shareholders believed this offer was too low, which resulted in a 2-month delay of the deal. The adjusted offer in August 2006 tacked on an additional $7.50 per share, offering to buy outstanding shares for $107.5. Also, investment groups in the LBO offered to assume $7.2 billion of Kinder Morgan's debt. This offer in total was valued at $22 billion and gave shareholders a 27% premium on their outstanding shares. Important multiples in this transaction are observed below. A low debt-to-equity ratio of 0.5 in this transaction relays the message that investors are using twice as much equity to debt to finance its deal. This low ratio also portrays that the company will be able to generate enough cash to satisfy its debt obligation. The debt-to-EBITDA ratio of 5.2 is fairly high for the year. However, investors' debt-to-equity structure verifies its ability to handle its debt burden in the future. The sources and uses of the fund come from 3 major groups, including major Kinder Morgan equity contributors, a consortium investment group, and a group of smaller investors. As you can see in the pie chart, Kinder Morgan contributors included Richard Kinder, Fayez Sorafim, and Mike Morgan, who in total provided $2.8 billion in financing. The investment group, who financed 2/3 of this investment with $14.5 billion, was made up of Goldman Sachs, American International Insurance, Riverstone Holdings, and Carlyle. The remaining $4.5 billion was made up of other investors recruited to provide additional capital for this LBO.
I will go into more depth regarding the financing composition of this leveraged buyout. Management contributed $2.8 billion in equity financing, with a majority coming from Richard Kinder. The investment group contributed equity of $5.1 billion, which is comprised of Goldman Sachs, Carlyle, American International Insurance Group, and Riverstone Holding. Roughly a third of this LBO was equity financed. The remaining 2/3 of the leveraged buyout was debt financed. $7 billion of existing debt will remain outstanding throughout the merger. $7.6 billion in new debt financing will come from banks such as Goldman Sachs, Citigroup Global Market Inc., Deutsche Bank Securities, Wachovia Securities, and Merrill Lynch, Pierce, Fenner, and Smith Incorporated. Goldman Sachs was the major player in this investment and collected $243 million from referral and other management fees.
The major regulatory issue arrived through the fiduciary responsibility of the company to its shareholders, mandated by compliance rules. Senior management had met with Goldman Sachs without board members' knowledge to discuss strategies to increase shareholder value. This is around the time where the idea of an LBO arrived, and Goldman Sachs immediately wanted in. Goldman Sachs had a conflict of interest at this time because they had an opportunity on being on the transaction side and the investment side of this deal. This conflict of interest, along with several other things, led to a shareholder class action lawsuit.
There are obvious legal issues with the leveraged buyout due to the conflict of interest of the buyout management team and Goldman Sachs. Richard Kinder, Mike Morgan, and Fayez Serafin comprise this group. Richard alone owned 18% of the company's shares. The shareholders were uneasy and were able to leverage the $107.50 per share buyout price and also threaten litigation because of controversial and allegedly unfair means of taking Kinder Morgan private. Shareholders were angry about how management and Goldman set up the deal. The LBO was announced and Goldman was the only firm that had time to do the due diligence. There were also no competing offers. Richard Kinder denied any wrongdoing but said settlement without trial was in the best interest for everyone. It wasn't until 2010 that shareholders received a $200 million settlement. $200 million as settlement.
When discussions regarding the transaction were in session, Kinder Morgan announced the company's intentions to build 1,300 miles of natural gas pipeline from the Rocky Mountains in Colorado to eastern Ohio. The project was to be worth an estimated $4 billion, capitalizing on increasing energy prices across the nation to generate abnormal future returns in years to come. Nicknamed the Rockies Express, the pipeline would become one of the largest pipelines constructed in the U.S., ultimately creating significant attraction to the buyout at hand. Analyzing previous LBO trends, the buyout of Kinder Morgan ranked as the largest leveraged buyout since Kohlberg, Kravis, Roberts & Co. bought RJ&R Nabisco in 1989 for $31 billion. A deal when now adjusted for inflation is valued around $55 billion. Looking ahead, Kinder Morgan was taken public once again during 2011 in what is still the largest private equity-backed IPO in history, raising approximately $3.3 billion through the issuance of 110 million shares. This offering was used to facilitate the acquisition of El Paso Corporation at a price of $21.2 billion in cash and stock. Lastly, we will discuss what constitutes not only a good, but great LBO candidate. First, if the stock price of the target company trades at a lower multiple to free cash flows as compared to industry averages, this signals that the stock is undervalued. Next, if the amount of debt on the balance sheet of a target company is lower when compared to the level of free cash flow, the risk of liquidity for future obligations is minimal. Also, if capital expenditure requirements to incorporate growth are low, more money will be passed on to shareholders in the future. Finally, if competitive advantages are achieved with the potential to generate future cash flows in excess of the debt used to finance the buyout. Significantly more earnings can be used to expand operations.